Hello everyone, welcome to the 191st episode of me learning how to trade in Forex. So in the last episode we went through finishing off the probability of profit video alongside some others. So the notes we'll go through, or I've made, we'll go through them now. So probability of profit is closely tied to the probability of an option expiring in the money or out of the money. The probability of an option expiring out of the money is an invert of the option expiring in the money, so they should add up to 100% basically. An option with more time has higher probability of expiring in the money. An option with a strike price closer to the market price has a higher probability of expiring in the money. At the money strike prices has the highest extrinsic value. As the option goes into out the money, their extrinsic value decreases along the probability of expiring in the money. So options has the highest chance of expiring out of the money when they're the furthest away from the stock price. Out of the money options have a probability of expiring in the money between 0 and 50%. At the money options have a probability of expiring in the money around 50%. And in the money options have a probability of expiring in the money between 50 to 100%. So less time there is until expiration, the closer these percentages will be, either towards 0 or 100. The probability of profit is a probability that a trade will have at least $0.01 in profit at expiration. The more space you have to be in the money, the higher your probability of profit will be. So when buying an option, the probability of profit is less than the probability of being in the money at expiration because the option is purchased for a debit. So this worsens the break-even price as extra premiums added onto the strike price. When selling an option, the probability of profit is greater than the probability of being out of the money at expiration because the option is sold for a credit. So this improves the break-even price as the extra premium is reduced from the strike price. So again, out the money percentage plus in the money percentage equals 100%. Probability of being in the money / out of the money at break-even price can be used as a rough gauge for the probability of profit for the options we're trading. Short options generally have a higher probability of profit but more potential monetary risk. Long options generally have a lower probability of profit but less potential monetary risk. So then we went through the volume and open interest video. So volume, open interest and bid-ask spread are the three main components of liquidity. The bid-ask spread is the front-facing liquidity indicator, whereas the open interest and volume are the background to put context for the bid-ask spread. So the volume is the number of contracts traded per day. The higher the volume, the more frequent that stock / contract is being traded. The more stock / contract is being traded, the more buyers and sellers there are, so the tighter the bid-ask spread is. Open interest is the number of contracts open or outstanding at a given strike price or expiration. Open interest is a forward-looking metric as it shows the number of contracts outstanding. So open interest doesn't apply to stocks as there is no expiration date for them. High open interests show a high level of market participation which will reduce the bid-ask spread. Stick to liquid markets when trading stocks and options. So they gave us some minimum recommended activity levels. So volume per day, 1,000 plus contracts. Open interest per day plus 1,000 plus contracts. Open interest could be a better indicator for future liquidity. And that's that. And I went through the implied volatility ranking and implied volatility percentile. So implied volatility rank and implied volatility percentile are metrics which are used to put context around implied volatility. Implied volatility rank and implied volatility percentile are used to see how the current market premium compares against the previous periods of time. So implied volatility rank is calculated using current implied volatility minus the 52-week low divided by 52-week high minus the 52-week low. So implied volatility rank puts the current implied volatility on a scale of 0 to 100, with low implied volatility being 0%, whereas high implied volatility being 100%. Take every spike or dip into applied volatility for consideration. However, note that an implied volatility rank or implied volatility percentile might be 100%, but always check the actual implied volatility percentage as well to ensure the full picture before placing a trade. So for implied volatility percentile, That is calculated by number of days under current implied volatility divided by number of trading days. So single day implied volatility swings can have a much more impact on the implied volatility rank than the implied volatility percentile. The implied volatility percentile shows how extreme the current implied volatility is. So high option prices are from 50 to 100 implied volatility rank. Low option prices are from 0 to 50 implied volatility rank. The higher the implied volatility rank is, the higher the implied volatility is relative itself over a course of a year. Oh wait, the higher the implied volatility rank is, the higher the implied volatility is relative, I think that's supposed to say to itself over a course of a year. Implied volatility rank under 50 usually indicates a premium is relatively cheap. Right, okay, so let's carry on where we left off that. I think she's around the 2-minute mark. So
is the higher the implied volatility is relative to itself over the course of a year. This could lead to
right, so it is relative to itself over a course of a year.
A premium selling opportunity, or potentially getting into a long or short stock position using short options at a great cost basis. IV rank under 50 usually indicates that premium is relatively cheap.
So implied volatility rank under 50 usually indicates the premium is relatively cheap.
And we could wait for a better opportunity to sell options or deploy a strategy that benefits from an increase in IV.
Wait for an opportunity to sell options or employ a strategy that uses a low IV, okay.
IV percentile can be used as well, but it's important to stick to one or the other.
Note to stick to using only one of only. Note to stick to only using one of the either just implied volatility rank or just implied volatility percentile.
If we switch from IV rank to IV percentile consistently, it makes it harder for us to see the tide of implied volatility and how it changes.
Regular switches between the two makes it difficult to see how the implied volatility changes.
Regardless, remember that we still need to check the actual implied volatility of an underlying.
So, note to check the actual implied volatility. Remember, I think we said this before, but
IV rank of 100 in a 150% IV environment is going to offer options packed full of extrinsic value. On the flip side, an IV rank of 100 in a 10% IV environment is not going to offer much premium at all. This is why we check IV rank first, but look at the raw IV percentage to determine whether the potential opportunity for selling premium is there or not. Let's review. IV rank and IV percentile both measure the current implied volatility against its historical range.
Implied volatility rank and implied volatility percentile both measure the current implied volatility against its historical range. Implied volatility rank and implied volatility percentile provide context around how high or low the current implied volatility of an underlying is. Yep.
This helps us put context around the current IV we're looking at, which helps us make trading decisions. IV rank is a simple calculation.
So, implied volatility rank is a simple calculation simple range bounding ranking system. It's a simple range bound ranking system. Implied volatility percentile is a weighted calculation and much more smooth.
And is ultimately a range-bound ranking system. IV percentile is a weighted calculation, and results are much more smooth because of that. Just because IV rank or IV percentile is high doesn't mean extrinsic value is high. It's important to remember that these are just contextual tools, and we need to check the actual implied volatility of an underlying to get the full scope of option premium and whether or not it's worth trading. Feel free to check out the written content in this section for more.
Nice, okay, so that's the implied volatility rank and implied volatility percentile video. On to the next, notional value and buying power. Value and buying power.
In this video, you'll learn about buying power reduction and notional value. Notional value is simply the real value or monetary risk of a position. Buying power.
So notional value is the real value or the monetary power of a position.
Monetary risk of a position. Notional value is simply the real value.
Is the real value
or monetary risk of a
or the monetary risk of a position.
Buying power is the amount of capital.
Buying power is the amount of capital
you have to trade with. And buying power reduction refers.
Buying power reduction
to the amount of capital required to place and hold a trade.
Is the amount of capital required to place and hold a trade.
Buying power reduction and notional value are not usually the same number, so it's important to understand the difference.
Real value monetary risk position, buying power reduction is the amount of capital required to place and hold a trade. So not the same number.
And notional value are not usually the same number, so it's important to understand the difference between the two concepts. Buying power reduction typically fluctuates with undefined risk positions and is static with defined risk positions.
So buying power reduction.
Important to understand the difference between the two concepts. Buying power reduction typically fluctuates with undefined risk positions.
Undefined risk positions.
And is static with
defined risk positions.
When it comes to trading, there are typically a few different account types that people have. Margin accounts, IRA accounts, and cash accounts. Cash and IRA accounts are cash secured, which means naked option and stock trades require the full value or notional value of the strike or stock as buying power reduction. If I were to buy 100 shares of XYZ stock at $50, I would have to put up $5,000. This is simply the stock price multiplied by the number of shares I'm purchasing. This is my real notional value and how much money I stand to lose if the stock goes to zero. If I were to sell a put at the 40 strike instead, I would only have to put up around $4,000 in a cash or IRA account. Remember, a short put option obligates me to be put 100 shares at 40, so that is the only amount required in terms of buying power in a cash secured account. I do collect a credit when selling the put though, so the buying power is typically reduced by the credit amount, since that reduces my max loss as well. Either way, notionally speaking, a 40 strike put has $4,000 in notional value. Margin accounts offer much more leverage, as there is typically about a 2-to-1 leverage with stock trades and around a 5-to-1 leverage with naked option trades. In other words, I only have to put up 50% of the value of shares of stock I buy, and only about 20% of the strike price of naked options I sell.
So margin requirements, now it's using leverage and stuff, so
In the same examples, I would only have to put up $2,500 in a margin account to control $5,000 worth of long.
Yeah, so this is the leverage now. So we're not paying the full value of the position. We only have to pay a little bit to control the whole amount. So leverage
shares of stock. This gives me a lot of leverage and doubles my potential return on capital. This could also accelerate my losses though, relative to the amount I'm putting up in buying power. Selling a put in a margin account gives me a ton of leverage as my buying power is only reduced by about 20% of the strike price. This means I might only have to put up around $800 to sell this put at the 40 strike. If I sell the put for $1.60, that's a 20% potential return on capital and a ton of leverage as well. To put buying power reduction in simple terms, the brokerage will require you to put up their view of practical max loss for a position given the time frame in the form of buying power reduction. $800 to sell this put at the 40 strike. If I sell the put for $1.60, that's a 20% potential return on capital and a ton of leverage as well. To put buying power reduction in simple terms, the brokerage will require you to put up their view of practical max loss for a position given the time frame in the form of buying power reduction. Although possible, it's not practical to expect a stock to go to $0 frequently, and brokerages account for this in margin accounts. That is why buying power reduction can and will be different than notional value risk in a margin account. While the broker does account for the difference in notional value and buying power reduction, it doesn't make sense for the brokerage to take on unnecessary risk, so they cover themselves by requiring a certain amount of capital up front to place a trade, and that number can change as the trade goes on. Even though buying power reduction for a trade may seem small, there is a substantial leverage in options trades in general, and more often than not, the max loss on a trade can be much larger than the buying power reduction with naked options. When you understand buying power reduction and how that relates to notional value, you start to see how important it is to fully understand the risk in trades we place.
So leverage is bad if you lose.
At Tasty Live, we approach selling premium like an insurance business. We sell options to give ourselves more ways to be successful, but in a lot of cases, we take on an undefined amount of risk. Just like an insurance business, we should expect to see a lot of premium come in the form of credits, but there will be some situations that require us to make payments out in the form of debits. In the long run, we bank on extrinsic value decay, implied volatility overstatement, and high probability trades to outweigh the bad with the good.
Notional value. SPY, TLT, GLD, FXE. Number of losses since 2005 larger than initial BRP. Buying power reduction, 600 plus occurrences, 7 from all 2008 crash, 4 from all 2008 crash, 1-0.
We believe that buying power reduction can be used as a practical gauge of real-time risk, as our research shows
can be used as a real-time risk gauge, right?
To outweigh the bad with the good. We believe that buying power reduction can be used as a practical gauge of real-time risk, as our research shows that more often than not, buying power reduction has been larger than the loss seen on a very high percentage of trades. In this graphic, you can see that this was the case over the past 13 years with a few popular ETFs.
ETFs are exchange traded funds.
But there were a few cases where the max loss was actually larger than the buying power reduction. This tells us that we still need to be cognizant of buying power reduction and its imperfect nature, but this also tells us that we can use buying power reduction as a practical measure of real-time risk. So, how do we combat the imperfect nature of buying power reduction in a margin account? We trade super small, which ensures that even if we do reach a loss higher than our buying power reduction, that loss is probably still only a small fraction of our total portfolio.
Hey, this sounds really similar to that. Only trading like 1% of your account. Yeah, never risk more than 5% of your account equity on any trade idea. 5% that's the maximum, so Keep your risk amount per individual trade area to less than 1% of your account equity. So yeah, so that means if you do make like multiple losses in a row, you're not going to lose that much of your account. And it's much easier to make that amount back in a winning trade than say like when you're risking like, I don't know, 10% on every trade or something.
With stock trades, long and short options trades, and defined risk spreads, which you'll learn about later, we make sure that our buying power reduction is never larger than 3 to 5% of our total portfolio value. When trading really small,
Was it?
make sure that our buying power is only a small fraction of our total portfolio. With stock trades, long and short
When trading stocks,
options trades, and defined risk spreads, which you'll learn about later, we make sure that our buying power reduction is
ensure the buying power reduction
never larger than 3 to
is never larger than 3 to 5%
5% of our total portfolio value.
of the total portfolio value.
When trading really small this way, we not only protect ourselves from improbable occurrences, we keep our leverage in check as well. If we're trading this small and keep a lot of cash on the sidelines, it'll be harder for us to be too leveraged in our portfolios. Let's review. Buying power reduction and notional value can be very different numbers depending on your account type. Buying power reduction is the capital required to place and hold a trade and fluctuates for naked options. Notional value.
So buying power reduction fluctuates for naked options.
Value is the real monetary exposure of a position and can be much larger than the buying power required to place a trade.
Notional value can be than the buying power reduction for a trade.
Traders can take advantage of real leverage when trading in a margin account, as those accounts offer 2 to 1 leverage on stock and around 5 to 1 leverage on short options trades. Congratulations! You've reached the end of Section 2, Trade Entry Concepts. Don't forget to take the quiz and prepare yourself for Section 3, where we dig into basic option strategies.
On to the next one, option delta. Option delta. This is the Greeks, isn't it? Theta Vega. Yeah, this is the Greek stuff. So option delta.
Now that you have a firm understanding of complex concepts work, we're going to dig into how option characteristics change as market characteristics change. When we buy or sell a strategy, we pay or collect a certain amount of premium, but the value and probabilities of that strategy can change in real time after we enter the trade. In this introduction to the Greeks, we'll talk about delta, theta, and vega, and expose you to a basic understanding of how option contracts live and breathe through market movements. We'll start with delta first, which is the rate of change of an option's price given a $1 move.
Delta, the rate of change of an option's price
In the underlying price. Enter the trade. In this introduction to the Greeks, we'll talk about delta, theta, and vega, and expose you to a basic understanding of how option contracts live and breathe through market movements. We'll start with delta first, which is the rate of change of an option's price given a $1 move.
Given a $1 move
In the underlying price.
in the underlying market price.
Delta tells us a lot of things, but directional risk is probably the most important.
Directional risk. Positive delta is equals long market. Negative delta is equals short market. So delta equals long market. Negative delta equals short market.
Different
Neutral delta 0 equals neutral market. neutral delta equals neutral market. Options, call, positive call equals positive, negative call equals positive put is negative, negative call is negative, negative put is positive.
Different options have positive or negative deltas because of how they benefit, but more importantly, where their risk lies. If I have a positive delta overall, I benefit if the stock goes up, but that also means I have risk to the downside.
Benefits if the stock is going up, did he say?
Different options have positive or negative deltas because of how they benefit, but more importantly, where their risk lies. If I have a positive delta overall, I benefit if the stock goes up, but
benefits if the stock goes up.
That also means I have risk to the downside. If I have negative deltas, I benefit if the stock goes down.
Benefits if the stock goes down.
But that also means I have risk to the upside. If I have neutral delta, I'm not affected by small daily movements in the stock price as much as if I had directional bias, but deltas can and will change. Strangles, straddles, iron condors, and iron flies all have pretty neutral deltas because we're taking risk on both sides of the market, just like you learned previously. Let's take a look at a few directional examples and uncover how option prices change given a $1 move in the stock price. Long calls have a positive delta because they offer the
long call options have positive delta. Okay, so that was before. So long call options have positive delta. Long put options have negative delta. Short call options have negative delta. Short put options have positive delta.
delta, I'm not affected by both sides given a long calls have a positive directional examples and uncover how option prices change given a $1 move in the stock price. Long calls have a positive delta because they offer the owner the opportunity to buy the stock at the strike price chosen. If the stock price increases, this increases the value of the option, which is good for the owner. Assuming all else equal, if the stock price rises $1, the call option will increase in price equivalent to the delta value it has. If the option has a 60 delta, for every $1 move up in the stock price, the option will increase by 60 cents. The value of this long call would increase to $3 if XYZ rallied from 40 to 41 in this example, all else equal. If XYZ dropped to 39 instead, the option would drop from $2.40 to $1.80, all else equal. Long puts have a negative delta because they offer the owner the opportunity to sell the stock at the strike price chosen. All else equal at the strike. All however how option prices change given a $1 move in the stock price. Long calls have a positive delta because they offer
the owner
the opportunity to buy the stock at the strike price chosen.
Strike price chosen, do you say?
Given a $1 move. Assuming all increases, this opportunity to buy the stock at the strike price chosen.
Yep. At the strike price. Long call options have positive delta as they offer the owner the opportunity to buy the stock at a strike price. At the strike price.
If XYZ dropped to 39 instead, the option would drop from $2.40 to $1.80, all else equal. Long puts have a negative delta because they offer the owner the opportunity to sell the stock.
The opportunity to sell the stock at the strike price.
At the strike price chosen. If the stock price decreases, this increases the value of the option, which is good for the owner. To sell the stock at the strike price chosen. If the stock price decreases, this increases the value of the option, which
the option value increases. So this is if the stock price increases, the option value increases as well. Also increases.
Given a $1 move in the call option will increase in price value of the option, which is good for the owner. Assuming all else equal, if the stock price. Long calls have a positive delta because they offer the owner the opportunity to buy the stock at the strike price chosen. If the stock price increases, this increases the value of the option, which is good for the owner. A sense drop from increases the offer the owner the opportunity to sell the stock at the strike price chosen. If the stock price decreases, this increases the value of the option, which is good for the owner. Assuming all else equal, if the stock price falls by $1, the put option will increase in price equivalent to the delta value it has, just like calls. If the option has a negative 70 delta, for every dollar down move in the stock price, the option will increase by 70 cents. This $3.30 option would increase in value to $4 with a $1 sell-off in the stock price. If the stock rallies to 41, the option would drop in value to 260, all else equal. If you understand this, understanding the short side of options and their delta exposures should be pretty simple. If a long call has a positive delta,
long call a positive delta, short call has negative delta.
A short call has a negative delta.
Have negative delta.
If a long put has a negative delta, a short put has a positive delta. Short calls have a negative delta. Because the short side benefits if the option decreases in value.
Because the short side benefits if the option decreases in value
rather than increases in value.
So basically the opposite of long call options. So if the stock price decreases, then the option value wouldn't increase. So if the option value doesn't increase, then the short side benefits.
One of the ways this happens is if the stock price drops. The option would be further out of the money and worth less at that point. Assuming all else equal, if the stock price falls by $1, the option will decrease in price equivalent to the delta value it has. If the option has a negative 40 delta, for every dollar moved down in the stock price, the option will decrease in value by 40 cents. This allows the seller to buy it back for a lower price and secure a profit.
As they offer the seller the opportunity to...
If the stock price falls by $1, the option will decrease in price equivalent to the delta value it has. If the option has a negative 40 delta, for every dollar moved down in the stock price, the option will decrease in value by 40 cents. This allows the seller to buy it back for
the opportunity to buy the stock
a lower price
at a lower price
and secure a profit.
Short call options have negative deltas. They offer the seller the opportunity to buy the stock at a lower price. If the option decreases in value, the short side benefits.
If the stock increases to 31 instead, the option will increase in value from $1 to $1.40, all else equal. The option could still be out of the money, but show a loss due to the increase in extrinsic value. Either way, as long as the option expires worthless at expiration, the seller keeps the credit received up front as profit. Short puts have a positive delta because they benefit if the stock price rises. If this happens, the market... Short puts have a positive delta because they benefit if the stock price rises. If this happens...
If the stock price rises,
the market provides a better opportunity to sell stock, and the put value decreases. Assuming all else equal, if the stock price rises $1, the option will decrease in price equivalent to the delta value it has. If the option has a 40 delta, for every dollar move up in the stock price, the option will decrease by 40 cents. Just like short calls, this is good because we want the option we sell to decrease in value after we sell it. Decrease by 40 cents. Just like short calls, this is good because we want the option we sell to decrease in value after we sell it. We can then buy it back for a lower amount to
as they offer the seller the opportunity to buy the stock at a lower price. If the stock price rises, the short side benefits. Okay.
secure a profit. If the stock drops by $1, this would increase the value of the put by 40 cents, which is bad for the seller. Still, the option could be out of the money, and we know that all out of the money options expire worthless, so we're less affected by losses on out of the money options compared to options that start to take on intrinsic value. As you can see, different option strikes will offer different delta values.
Delta traction. Positive deltas range from 0 to 1. Negative deltas range from -1 to 0. Deltas closer to -1 or 1 will have more option price traction. For example, $1 increase in stock price, 0.25, change in 0.25 equals plus 0.25, change in 0.85 equals plus 0.85.
Positive deltas range from 0 to 1.
Positive deltas range from 0 to 1. Negative deltas range from -1 to 0.
And negative deltas range from -1 to 0. The lower the probability is that the option will expire in the money, the lower the delta value will be. An option for different delta values. Positive deltas range from 0 to 1, and negative deltas range from -1 to 0. The lower the probability is that the option will expire in the money, the lower the delta value will be.
The lower the delta value will be.
An option with a delta of 25 will have much less traction than an option with a delta of 85. The higher the delta, regardless of whether it's positive or negative, the more sensitive the option's price will be to changes in the stock price.
So the higher the delta, regardless of the positive/negative, the more sensitive
of whether it's positive or negative, the more sensitive the option's
will be.
Price will be to changes in the stock price.
The option's price will be to changes in the stock market.
Traction than an option with a delta of 85. The higher the delta, regardless of whether it's positive or negative, the more sensitive the option's price will be to changes in the stock price. Like I just mentioned,
Stock price.
the lower the probability of the option expiring in the money, the lower the delta it will have. The higher the probability of the option expiring in the money, the higher the delta it will have.
The probability that the option will expire in the money, the higher the delta value will be.
Delta and the probability of expiring in the money are very similar numbers most of the time, so delta can be used as a back-of-the-hand tool to estimate probabilities. A short call with a delta of -30 could have a 30% probability of expiring in the money, which means it has a 70% probability of expiring out of the money at expiration. An at-the-money option could have a 50 delta and a 50% chance of expiring in the money, and
Option delta equals probability of being in the money.
A 60 delta call could have a 60% chance of expiring in the money. This is a handy tool to use if in-the-money percentages are unavailable or if we're looking to quickly estimate probabilities using delta. If you understand how in-the-money probabilities work and change through the life cycle of a trade, you'll understand how delta works too. When it comes to delta, there's a number of different things we consider. If we own 100 shares of stock that have a positive delta of 100, and we're hedging them with a short call, we usually sell the call that's around a 30 delta. This ensures that we're still giving our shares of stock some upside profit potential, but we're also effectively reducing our cost basis with the credit collected. In this example, we'd hedge our directional risk by 30% compared to owning shares outright. If we sold a negative 50 delta call, we'd have minimal upside profit potential in the shares, but we'd collect more extrinsic value premium in the short call. It's all a trade-off when it comes to hedging delta in covered calls. At the end of the day, we like to view delta as our directional risk gauge.
Yeah, I didn't really get that.
Number of different things we consider. If we own 100 shares of stock that have a positive delta of 100, and we're hedging them with a short call, we usually
hedge them with a short call. Offer the seller back to the stock, buy the stock at a lower price if the option decreases in value.
Usually sell the call that's around a 30 delta. This ensures that we're still giving our shares of stock some upside profit potential, but we're also effectively reducing our cost basis with the credit collected. In this example, we'd hedge our directional risk by 30% compared to owning shares outright. If we sold a negative 50 delta call, we'd have minimal upside profit potential in the shares, but we'd collect more extrinsic value premium in the short call. It's all a trade-off when it comes to hedging delta in covered calls. At the end of the
I still don't get that, to be honest. For that reason, I'm going to leave this episode here. In the next video, hopefully, I'll have a big brain moment and understand what he's talking about. So, yeah. So thank you for watching, and in the next video, we're going to carry on with option delta at around the 2 minute 30 seconds mark. See you in the next video.